Is everybody getting that?
What's your risk-free rate?
Risk-free rate is 4.93%. Is that what you are getting?
The number in parentheses.
This is the equation in the middle here. This is not 5.
That number in the middle is 5%.
This is 5%.
The number in the parentheses
This
is
is,
5%.
I'm sorry.
Yeah.
Yeah, this is 5%. This is 1.6. And this is 4.9. Y'all getting there?
They'll start it out with 5 minus 4.
Oh, y'all were taking the 5 minus the risk-free rate? We all taking the 5
It's tricky,
minus
guys.
the
I
risk-free
mean,
rate?
valuation is tricky all along the way, so don't be discouraged. I mean, I have to do this, and then I have to double check it, and triple check it, all the time. Yes. Okay. So I'm going to first write the equation. 1.6, which is the aggregate beta, times 5% plus 4.93%. You're dealing with percents too. That's, you got to move the decimal. Equals 12.93%.
I mean, he's right.
Here it is written up here if you want to see it. Sorry, that's a percent. Does that make sense? No?
Could you?
Okay.
Sorry, I'm not getting where you
Yeah.
got 1.6.
Okay, the 1.6,
That's where we took the average data.
we unlevered the comp set, and we got a 1.28, and now we have to re-lever that.
Okay.
This is an average.
Okay.
Now we re-lever it for Mercury's debt, or actually equity to cap. We said their equity cap is 0.8. So 1.28 divided by 0.8 gives you 1.6. And now we're using that here, and we're taking the risk-free rate, which the case gave us was 4.93%, that's 20-year treasuries, plus the market risk premium, which the case also gave you at 5%. You take 5% times 1.6 plus 4.93.
Yeah, but doesn't it subtract out the risk-free rate?
This is just giving you, good. This may be where you are tripping up.
Yeah.
This is 5%.
Oh, altogether.
That is 5%.
I got you. Okay.
They just
Because
give you-
RM is market
risk
return.
Premium is
Market return minus the risk-free rate.
market, yes.
And that gives you the market risk premium. They were confused because they saw the RM and assumed that
We were
was...
trying to calculate.
I see. Did the case didn't give you the market risk.
They didn't give
just
us-
gave you 5%, which is the result of this equation.
Market risk is really 9.93.
Did they? Yes. Yes.
9.93.
The case didn't tell you that, but
Yeah, okay.
these cases don't give you everything. Sometimes you gotta really work through it.
Okay. Now, yes.
To get that data, you say the available 0.6, you take your average unlevered data, 1.28 times 8%.
Divided by 8%. Here's the equation. Where is it? Right here. Once you unlever the comp set, you've got an asset beta. That's an unlevered beta. Okay? You know that the case said that the leverage of Mercury is 20%, so that means that's debt to value. So you say 1 minus that equals equity to value. Equity to value is 0.8. So you take this divided by this, gives you that. You're trying to solve for equity beta. So to solve for it, you've got to move this, remember moving this underneath to solve for it. Okay? This is tricky stuff. It's not easy. Okay. Keep going. We're actually a little ahead of schedule.
I have a question.
Yes.
Do you know what page is not in the case?
What page? What?
What page in the case are those numbers?
I think it's in a footnote.
4.9.
What page did you find?
7 is.
Page 7? Footnote? Yeah, it's a,
That's in the final.
Yeah, for the risk.
now that we've calculated the cost of equity, what we're now doing, so let's just back up from all these calculations. We just calculated the cost of equity in Mercury. What does that mean? What is cost of equity? The expected annual return to shareholders. And shareholders expect, for the risk of Mercury, they want to see a growth in their investment of 12.93% annually. Okay? That would be, that's what they expect. Debt, let's say they did have bank debt, even though they don't. The interest rate, what are interest rates now for loans to corporations? 5%, 3.5%. So their expected annual return, which is interest, 3.5%. So there is a difference in financing your company with debt versus equity. Equity is more expensive, but you run a risk, if you finance your company with all debt, you run a risk of bankruptcy, right? Because you've got to pay that interest and you've got to pay the principal back. With equity, equities, you can't disregard, equity holders are expecting a greater return, but they don't have you don't have the obligation to pay them annually in interest. You can pay them annually in dividends, and hopefully you do that. But because equity holders are, if you think about a balance sheet, look at exhibit. What's the exhibit with the balance sheet? Yes. Is that exhibit 4?
7 is projected.
7. Okay, let's look at the projected balance sheet. Let's say, okay, Mercury does not have any debt, but let's imagine they did. Those, this is not great. Where's the historical? Let's go back to exhibit 4. Page 11. So what we're saying here, those owners' equity, which in 2006 was $214 million. What we're saying is those owners are expecting a 12.9% annual return. If there was debt here, the debt would be further up on the liability side, and they would get paid back first. In an event of bankruptcy, debt holders get paid back before equity holders. Equity holders get whatever's left after all of the debt and liabilities is paid off. Therefore, that's greater risk for equity holders. Equity, for being at the bottom of the balance sheet, expect more return for their greater risk. So equity is always going to be greater than debt. So when we're always doing kind of a sanity check here when we come up with a CAPM, that has a lot of influence on value, is what you just calculated CAPM to be. Companies that are really large, solid, proven cash flows, Walmart, for example. Think about their CAPM, or cost of equity, versus, say, a private company that is solid, but not as well capitalized, and that doesn't have as much access to liquidity. There should be a pretty good spread or difference between the CAPM of Walmart and the CAPM of that other company, right? So you always want to kind of do a sanity check of what are you calculating cost of equity to be? It should be more than debt, but so we talked yesterday about returns, right? We said venture capitalists expect what kind of return on their equity annually? 25 to 40%. What about private equity? What kind of returns do they expect? Different market conditions are different, but I'd say right now, high teens to, I'd say 30, 35%. Let's say 20s, in the 20s, annual return, they want to see, they will not purchase a company unless they see that they can get to an annual return of in the 20s. That they're growing their investor dollars. They have to. They're investors. They're investing other people's money. They have to get that kind of return. Okay. Really solid companies that are low risk, that are large. You can see cost of equity 10%, give or take. So that's just ballpark figures. Okay. Does that all make sense? These are concepts that you can't point to it as a tangible object. These are all this conceptual, and you have to really let it sink in. Let's now calculate the WACC. You've got the cost of equity, right? You just calculated it. You know the equity to value. What did we say that was? We just used that to re-lever 80%. We know what debt to value is. The case gave that to you. It's 20%. You got to find the cost of debt. The case gives you that, and you got to find the corporate tax rate. So let's calculate WACC.
Do that again. So, but it's supposed to be 50%.
I missed that on the first one.
Very good.
And then you avoid multiplying the debt on the debt by tax. So what's the tax rate for it? So 40% of That's the